You're watching Startup Central with me, Nentara Rai. There has been a trend that we spotted of late, which is more and more startups taking out press releases of fundraisers, not equity fundraisers, but via venture debt. What is venture debt? How does it work? How does it win over equity? When should startups go for venture debt? When should they not go for venture debt? I'm going to be discussing that and more with someone who made India familiar with venture debt. It is Rahul Khanna, the co-founder of Trifecta. Incidentally, Trifecta is back with a new fund. So Rahul, before we begin the masterclass, tell us about this new fund close.
Yeah, thanks. Thanks for having us on. This is an exciting time for us. We recently closed Venture Debt Fund 2 at over 1,000 crores. This is a fund that we had initially raised in 2019, March 2019. We had raised about 750 crores coming into COVID, and then things took a little bit of a pause. We exercised the green shoe of the fund, which was 250 crores, and over the last couple of months finished up raising the fund. So this fund now is at 1,025 crores, which is the largest venture debt fund that's been raised in India to date.
Okay. Now, Rahul, as just an observer of the startup ecosystem, I feel that more and more startups are liking the idea of venture debt, that they're going down this route. Is that correct? Is this big financing tool becoming more popular?
Absolutely. I think what founders have realized is that as they grow their company, they need a range of financing solutions. Equity is great, it has its role to play. But increasingly, as businesses grow, they have inventory financing needs, working capital financing needs, lumpy cash flows, deposits, things like that. And financing that with equity becomes very expensive. So I think as founders mature, as companies get larger, and as tech companies get to scale, their financing needs also evolve. And so we've seen a far greater use of venture debt in the growth stage than we had seen before.
The Trifecta, of course, is one of the early movers when it comes to venture debt in India. So Rahul, I also want to pick your brains. Think of it as a masterclass for venture debt for all the young startups that are tuning in and watching you at the moment. What kind of startups should be looking at venture debt? It's not for everybody. So as this financing tool gets more popular, I want you to explain to our viewers what kind of startups should be looking at it in the first place.
That's right. Yes, venture debt is not for everybody, but it can be a great tool at the right stage of your company's growth. Typically, we advise companies to raise their first form of financing with equity. Typically seed and Series A financing sets you up to get past concept stage. Once you've found product market fit, and really now you're dealing with execution, that's when you should be looking at raising venture debt or any kind of credit for that matter. So we think that the right time to really take on the responsibility of servicing debt is when you found product market fit, you have some unit economic model, and you know that you have a path to being able to continue to service the debt as you grow your company.
You've been around for a while when it comes to India's ecosystem. I want to inform our viewers of the kind of a portfolio that you have, and look how well they've become to do. Big Basket, ShareChat, Inframarket, just become a unicorn, Big Basket. So you discovered all of these via venture debt or through equity? How are they in your portfolio?
No, so these are companies that we have worked with now as a provider of venture debt for the last 5.5 years. So Trifecta Capital started investing in late 2015. On a cumulative basis, we have done about 2,000 crores of venture debt into 72 companies, of which now 9 have become unicorns. And most recently, Inframarket is one of those companies that achieved unicorn status. So the companies that we work with, predominantly we provide credit, but in all of these companies, we typically have a small equity option. So as these companies grow in value, our equity options also appreciate.
And Rahul, I've observed another trend, which is that any announcement of venture debt fundraise is often accompanied either before or after with an announcement for equity fundraise. Usually it's after. What's that about?
Generally these two events happen close to each other. More often than not, the equity check will come in first, and then we'll come along with that. Sometimes, companies may be very close to raising an equity round, and as an insider, we may find enough comfort in providing them support prior to the equity event. But more often than not, what you hear is companies raising a 25 million round of equity, and then maybe a month or two later raising 5 to 6, crores or million equivalent of venture debt, right? So I think the idea is that venture debt and venture equity are sort of companion asset classes. And as companies continue to grow and raise more equity, we should be able to support them with incremental debt.
So can you tell us what goes behind the scenes for a player like you to give checks for venture debt? What is it going to take for Trifecta to say, okay, this is a startup that we would like to lend to?
So candidly, we get involved with businesses that are typically after Series A, in most cases after Series B. I think what we're looking for is obviously strong teams. And I think having been a market participant now for a long time, there are certain patterns that we look for with great founders. So it starts with a great team. Then we look at the quality of the business. We try and understand the unit economic model. We try and get comfortable with the underlying business itself, because oftentimes at a very early stage, companies do not have that unit economic model figured out. And if they don't, then that's fine. Maybe we just wait. So we look at the business, we try and understand the growth needs and the financing needs of the company. We look at the quality of the equity investors. We find that our most successful companies also have had very high quality support from VC funds, and we've done many deals with Sequoia and with Axel and with Elevation and Bessemer. And so we look at the quality of the equity investors. And then, of course, we look at the end use, of the money. And if we feel like that end use is justified with debt, then, we try and find a way to work together. Besides that, I think category leadership and a conviction around these companies' ability to keep raising more capital is an essential ingredient in the underwriting process. I think at Trifecta, because most of our team are folks that have come from an operating background and an investing background, our ability to understand risk is one of the key differentiators that has allowed us to keep our NPA down to less than 1% over 5 years and over 72 companies.
I would imagine that venture debt is more expensive than regular bank credit. The question is, how much more?
Sure. So think about, a continuum of financing cost, where a typical bank will operate in a band of, say, 8 to 12%, and a typical NBFC will operate in a band of 16 to 24. Right? Venture debt fits nicely in the middle. Typically venture debt interest rates are around 14 to 15%. And then there's a small equity component which allows for the funds to make a slightly higher return. But in effect, companies are able to borrow at between 14 and 15% interest rates.
And is it cheaper than equity? Is venture debt cheaper than equity?
That's right. It's definitely cheaper than equity, and it comes with a lot less baggage than from borrowing from an NBFC, right? Because traditionally that will require, could be a pledge of shares, could be a personal guarantee, things like that. In venture debt, it's not common to seek that kind of security. Our debt is all secured, but it's secured against fixed assets, current assets, the brand, and the IP. We typically have the security package at the company level, and so it doesn't really impair the founder or the promoter in any manner.
And what happens now to venture debt in 2021 with this rising trend of the ecosystem maturing, you're seeing consolidation, you're also seeing a lot of them dreaming big when it comes to wanting to IPO. What happens to a player like Trifecta, which is then given venture debt?
Right. So we have two instruments. We have the debt instrument, which continues to get serviced. So if the company is private, it continues to service the debt. If it goes public, it continues to service the debt. The equity options that we hold, typically we have an opportunity to exit those whenever we want. And usually that equity option we sell by way of secondary to either the existing investors in the company or to incoming investors. So I think the important sign here is that there is clearly a tipping point as it comes to this ecosystem in 2021. We've been investing as Trifecta for the last 5 years, but I've been investing since 2005, and I've never seen this kind of scale and momentum in this ecosystem. We're sort of calling this the golden decade of exits because we believe that a lot of the capital that came in the last 15 odd years has now gone into companies that have matured quite substantially and rightfully are ripe for liquidity events, right? From a founder's perspective, the liquidity event is just one more step in the journey. But from an investor's perspective, that's also an opportunity to return capital to LPs, which is a very important part of the cycle of continuing to deploy more capital. So we do think that, as these companies go out and raise more capital, there'll be new use cases, right? So we recently funded an acquisition because the company was not necessarily wanting to dilute much more at this point. So we came in, provided some debt financing, and they used that to fund an acquisition, which is a completely new use case that we didn't see 2-3 years ago.
Okay, Rahul, thank you so much for being so patient and taking us through all of this. I know it's a big deal. You've closed this new fund of over 1,000 crores, but we didn't want to miss this opportunity to have a masterclass of sorts on the new trend of venture debt. With that, we're going to take a short commercial break. On the other side, eBay is taking Ayurveda to the United States of America. More on that when we return.